So if you were worried around the summertime that the Fed was maybe behind the curve in terms of cutting, what do you think now? We've had a lot of people questioning whether they should be cutting rates at this point.
I think they've got to get to. I think our team thinks they're going to cut today. You had Michael on, I think, earlier, and then a couple of times next year. But think about what they're really saying is the end state of the Fed funds rate will be in the 3.5% to 4% range, not in the 2.5% to 3% range. That was a big change over the last 6 to 9 months. That's because inflation still doesn't get down to sort of lower twos they have until 26. So with that length of time, they've got to stay higher than they'd otherwise be. It's a real rate structure. It's very restrictive on small, medium-sized businesses because that's who they were borrowing at 300 basis points over 50 base, SOFR at 50. Now then they went to 300 basis points over 5.5. Now they're back down to 475. That's still a lot more interest costs. They've slowed down, quit using the lines as much. The activity year over year is okay. It would be a lot stronger as rates come down because then it's just cheaper to borrow. And that's where the real restriction, the real rate structure is there. So they have to come down a little bit to get more normalcy in the system.